Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've just seen the Reserve Bank make its first announcement for 2023. It's had a pretty long holiday and a lot has happened over that holiday period. Cyclones, floods, even a bit of summer, I think, maybe in the middle of it. The Reserve Bank, though, deciding to come out with a 50 basis point increase to the official cash rate, taking it to 4.75%. It's a little bit lower than where the bank itself might have thought the official cash rate would go to back in November 2022. But to be fair, there's sort of a bit of a sign in a sense that maybe there are a little bit of better things to come. Inflation hasn't gone as high as the Reserve Bank first thought. But importantly, at 7.2% on an annual basis, it's plateaued. That's good news on one hand. Hasn't gone down though. It hasn't started to pull back and moderate yet. So again, the inflation battle surely isn't done yet. What more is there for the Reserve Bank to do?
I think the message from today's statement by the bank was that it's very much kind of business as usual for them still. You mentioned the cyclone and the other disruptions that we've had over the last few weeks, but the bank still says the economy is stretched. We've got the unemployment rate down below 3.5%, and so that's not something that can be sustained. And they are still looking to bring inflation down over the next 12 to 18 months before we're getting it back within that 1 to 3% band. So while it's not as large as maybe the 75-point increase we were thinking of a month or so ago, there is still the message there from the bank that the OCR is pushing up towards 5.5% by the middle of this year, so possibly another 3 increases of 25 basis points. So there is still more work to do, but you're getting into that phase potentially of the cycle with just a few signs that the labour market is just starting to lose a little bit of momentum. Maybe we're on top of inflation even if we haven't actually started to bring it down yet. So those signs suggest the Reserve Bank doesn't need to be maybe quite so, I guess, stringent or hard in its moves going forward, but it does still need to continue to tighten from here until there's more confidence that it has slowed the economy and engineered a recession. Very much still that's showing through in their numbers for GDP through the course of 2023.
Yeah, absolutely. And I guess when we look through those figures, you look at their inflation track, although inflation wasn't as bad as they had originally thought in the December quarter, and also you've got the fuel tax subsidy by government that has now been pushed out until at least the middle of this year. That's sort of taken the top off with the additional spike that the Reserve Bank thought would come through in inflation. But looking through the numbers, you're not really seeing a moderation in inflation any quicker. It's following the same pathway it was before, effectively. In terms of that recession that you talk about, it's still, like you say there, a 1.1% reduction in economic activity from top to bottom. That's sort of, it's not insignificant, but importantly, it's also coming off a very strong level still of economic activity. GDP in the September quarter of last year, of course, rising 2.0% on a seasonally adjusted basis. So that starting point was a lot stronger. And then I guess the challenge that the Reserve Bank's got at the moment around the cyclone is looking through what is likely to be at least more short-term temporary pricing challenges, higher accommodation costs and rental costs as more people effectively look at fewer number of accommodation options. Food crops that have been destroyed, of course, means that demand is still there, but supply is less. And there's a lot of construction and reconstruction to be done. That means that, again, supply hasn't changed, but demand is up. All of that suggesting, like you say, there's sort of further work to be done. And I think that messaging is important. The Reserve Bank doesn't need to shock the system quite as much as it did in November and say, look, there's a huge amount more to be done. But they do need to continue saying we're not over it yet. Inflation, the inflation battle isn't won. You may be starting to see the dial move a little bit further in the Reserve Bank's direction of who's winning, but we're not finished with it yet. And importantly, the Reserve Bank's still worried about those high levels of inflation expectations. Going forward then, what does that look like for interest rates and what sort of influence does that have on the economy? Are we likely to see house prices that continue to move in a downward direction? And again, sort of how long does this last before the Reserve Bank can start to pick up an expectation that maybe they need to cut interest rates and stimulate a little bit more activity in the economy?
Yeah, I think with mortgage rates over the last couple of months, there've been mixed sort of movements in those. Some of them are starting to come down. I think financial markets may have got a little bit ahead of themselves with just how far through that inflation battle we've got, and we could see, I think, a response over the next few weeks of possibly mortgage rates starting to push higher again, particularly down the shorter end of the curve, where the OCR has a greater effect on some of those shorter-term fixed rates. So there's possibly still some pressure there. That will translate, I think, through into further house price declines. There's not really been any sign of a moderation sustained in those house price falls yet. They're still going down at about 1% a month, and that's probably going to continue through until the middle of this year, if not to the end of 2023, even possibly into early next year as well. In terms of when the Reserve Bank might be able to start cutting interest rates, you're talking a good 12 months probably after they've reached the peak. You've got to sort of sit tight for a while, let those higher interest rates sort of do their work and flow through the economy. And so it's probably not until mid-2024 that there starts to become scope for interest rates to be cut by the Reserve Bank. By that point in time, we would expect unemployment to be pushing up to possibly around about 5%, so spare capacity coming through in the labour market there. We'd expect inflation to have come back significantly from its peak, maybe not within the Reserve Bank's target band at that point, but it will be a lot closer to it, and the Reserve Bank will be secure in the knowledge that they have got on top of those inflation expectations and that price setting behaviour. But like I say, it probably is another 15, 18 months away from here yet before we can start to think about some sort of a relief coming through for the economy in terms of those lower interest rates.
Yeah, so I mean, look, all in all, a fairly sensible decision then by the Reserve Bank, and also a sensible outlook that there is still more work to be done to bring inflation under control. We're not finished with that battle yet, but after really shocking the markets in November and putting across a very forceful push of, the sort of work that needs to be done, that sort of what you've been seeing by the Reserve Bank does highlight that, they're still working on it. They're still working on inflation, and they're still expecting some of those harder hits. But they're also, I guess, recognising that it has been some better movement in the numbers starting to come through, which suggests that maybe the battle is at least turning in their favour. We'll assess where economic conditions go next, what the Reserve Bank has to do in the future, and how that affects the wider economy in one of our future editions of Econ Talks.